As a Canadian, it can be super hard to decide what should you put or not in your TFSA. Should I take some growth stock or maybe value stock would be the better option? Well, in this video, you will find out what is my personal approach to this problem, and I will share with you what are my top 3 stocks that I might be most likely buying in 2022 in my TFSA. Hey, how's it going, guys, and welcome to the North Investor, where we're all about personal finance on our path to financial freedom. So a TFSA stands for a tax-free saving account. As you guys know, when you earn money, for example, from your salary, this money will be taxed initially by the government. What the TFSA does, basically, it offers you possibilities to grow your money after that it has been taxed by the government, to put it somewhere where it grow free from taxes. So for example, you have your contribution that you have, for example, in 2022, it is $6,000 that you can put in your TFSA. And for example, if you still have not invested in it, and if in 2009 you were major, so you were 18 or plus, what you can do, basically, you can invest until $81,500 straight into your TFSA. Plus all the withdrawal that you do from your TFSA. For example, if in 2021 you withdraw, I'd say $5,000, well, you can add them to your initial contribution of the year. So it is literally a gift from heaven, from our government, and it is an opportunity that you must jump on. However, it's super important to understand that everything that is not Canadian in your TFSA, for example, if you hold any American stocks, let's say, well, they will be taxed on an American side, because on the Canadian side, obviously, it's all tax-free. But because this kind of program doesn't exist in the US, I'm sorry for all of my American neighbors, but this means that basically everything that is from the US in your TFSA will be taxed when you sold it from the capital gain point of view. So many of you will be tempted, obviously, to hold only Canadian stocks and Canadian bonds, for example, in your TFSA. This could be a pretty good way to invest in it on the fiscal side. Personally, that's one of the things that I do in my TFSA. I do invest a lot in Canadian dividend stocks because obviously capital gain is taxed way less. Only 50% of the gains that you have made are taxed, compared to like 1.38 of majoration on the dividends. So I invest mainly in Canadian dividend stocks in my TFSA, and that's why in this video I will present to you what are my top 3 Canadian dividend aristocrat stocks to put in my TFSA. However, I do also own some grow stocks from the US that I think that will potentially outperform some Canadian stocks in the future. For example, Facebook is a great example of it. Before to share with you what are my picks, let me share with you what is my perspective of the market for 2022. So for this market, I personally see 4 big threats for 2022. First, I think that there is the political war between the US and China that might be impacting the market, mainly on the emerging market for the Asia part, because this obviously is impacting valuation in the Chinese stocks. For example, Alibaba and NIO are highly undervalued because of that. Secondly, there is the overvaluation of many stocks on the stock market at the moment. I think that some of the big techs, and I won't say any name, but I think at the moment they might be a little bit overvalued. I think that in 2022 they will continue to grow their revenues and grow their profits, but maybe there will be a little readjustment on this side. Also, obviously, we still have our good old friend, the COVID-19, that is still there in 2022. And with the Omicron variant, obviously, this will impact a lot of people. Here in Quebec, we're still in lockdown, and I know it's kind of hard for everyone, but I think this won't have much impact on the stock market since we are prepared to face it. And now it's been like 2 years that we have faced this problem, so we are more prepared to face it. And this is the good news, I'd say, on this side. And finally, obviously, the threat that is the most threatening in my eyes is the interest rate that will potentially increase due to the high inflation that is at its highest point since like 40 years. And this will impact all our economy, I think, personally, on that side, because as many of you might know, probably the governments will increase the interest rate, which will impact all our other sectors. For example, on the mortgage side, the people that have mortgage on their houses with floating rates, well, they will potentially pay way more interest in the years to come because of the rates that will increase, and that will make that they will have less money to inject in the economy and to buy more things. The companies that will potentially enjoy these high rates are obviously the financial sector. This is leading us to my first stock, and to share with you those stocks, I've decided to divide them in different sectors. And the first sector that I will present to you is the financial sector, and the first company is Manulife. With a market cap of over $50 billion, Manulife is currently the leader in insurance in Canada. It's also the second biggest company of this type in North America and the fifth one in all the world. Manulife has different offices in Canada, in the US, but also in 19 other countries in all the world, with more than 55,000 employees spread all over the world. The principal shareholders of these companies is BMO, RBC, and Vanguard. This company made about $77 billion of revenues in 2020, and more than 38% of all the revenues are coming from Asia. Manulife is currently one of the most undervalued dividend growth company in the whole Canada, with an incredible P/E ratio of only 7. We can also see that the other valuation measures are super low, like the price-sales ratio of only 0.83 and the price-book ratio of 0.95. As I told you earlier, this company also made a lot of revenue, as we can see in the last year, around $56 billion of revenue, and in the last quarter, a big 20% of growth in their revenues. Another super crucial point for an insurance company is to have a lot of cash to be able to face any kind of difficulties that they could have to face in the future. And Manulife does answer to this question pretty well, with more than $35 billion in cash. And we can see that they have $15 billion of more in cash compared to their debt of only $20 billion. And finally, obviously, we need to take a look at the dividends, which are around 5% per year, which is actually pretty good for a company that has been growing their dividends since many years now. And also their payout ratio is super low, which is a pretty good news. That means that this company is not using too much of their return earnings to be able to pay to their shareholders their dividends. When we look at the P/E ratio and at the dividend of Manulife, we clearly see that it's a way better choice compared to another insurance company just like Sun Life. Personally, I expect a tremendous year for all the financial sector, and that's why Manulife, in my opinion, is really one of the top stocks that you should look at, because it offers a great mix of growth and dividends potential for the future. And this is really, I'm really optimistic on this side for this company and for all the sector in general. That's why I'm keeping also an eye on all the top 5, so the big 5 bank in Canada. Now for my second pick, we will go into the energy and into the oil sector with a solid company that is known by many investors in Canada by being one of the dividend aristocrat here, which is Enbridge. Enbridge is currently the largest gas distribution network in Canada. It has different pipelines all around Canada and the US, and notably it owns the largest and the longest pipeline in all North America that measure about 38,000 kilometers. This pipeline notably transports more than 20% of all natural gas that is consumed by the US. Now, I already see all the green energy and renewable sector specialists come at me and say, well, I don't think that this kind of investing is great for the ESG type of investing. Well, actually, despite the fossil fuel being the main activities of Enbridge, they have recently accepted to a net zero clearhouse gas emission by 2050 and also by 2030 to have a decline of 30% the intensity of all the gas emissions from this company. Enbridge has made many different acquisitions in the past. For example, in 2021, where they acquired Moda for about $3 billion. The principal shareholders of this company are pretty much the same as Manulife, so they are RBC, BMO, and also Vanguard. When we look at the valuation measures of Enbridge, we clearly see that it's a leader in its field in North America with a market cap around $100 billion and also a super affordable P/E ratio of around 16. Also super interesting to see that the revenues are almost $55 billion, and we see that the revenue per share are actually quite high. And what is interesting to see is another company with a lot of growth in the past quarter, just like Manulife, almost 26% of quarterly revenue growth, and also some EPS of almost $3 per share. The little negative point I would have to say for Enbridge is that they use a lot of debt to be able to make the company go well, and in this case we can clearly see it on the balance sheet when its cash is not even $1 billion, it's only about $500 million if I want to boost the numbers, but we see that debt is way higher than it. It's more than $70 billion of debt, which make that the debt equity ratio is pretty horrible, and this is also going to reflect on the dividend payout ratio. So we can clearly see it right now in this section with the dividends, that first of all, the dividends is actually insane for this company. Knowing how much debt they have compared to the cash they have, we see that they are really willing to let the shareholders come to them and to try to attract them to come and invest in the company. They offer more than 6% of dividend. And the only negative point, as I told you, they use a lot of debt, so their payout ratio is higher than 100%, which means that they need to use debt to be able to pay their dividend. So as we can see it in this section for the dividends, it's quite insane how they are giving a lot of money in their dividends to their shareholders, almost 7% of dividends, which is really insane comparing all the cash they have compared to the debt that they have, and this is reflected in the payout ratio, which is higher than 100%. Personally, I think that Enbridge is a company that you can't sleep on. It is currently one of the main actors in all the energy sector in Canada, but it also has a lot of potential, notably because of their green turn that they have made recently. But when we take a look at all the other companies in this field in Canada, I really keep an eye on two other companies, which are Pembina, one of the main competitor of Enbridge on that sector, but also on the green side, I take a look at AQN that has a massive dip on the moment and a massive buying opportunities on my personal point of view, and that will be potentially a great actor in 10-15 years apart from it. Now for my third and last pick, I've decided to choose a company in the telecom market in Canada, and this is a company that is known by many Canadians, and the company is TELUS. For those who don't know the telecom market in Canada, this is basically split between three companies. So you have TELUS, Bell, and Rogers. TELUS is currently the second biggest company of this type in Canada, just behind Bell. It currently has more than 4.5 million of access lines around Canada, with more than 1.05 of millions of internet users. And it also have 4.5 million of cell phone subscribers. TELUS is really a company in constant growth, and here in Quebec, the competition is really between Bell and TELUS. In the third quarter of 2021, TELUS has had more than 300,000 customers in Canada. And finally, for the valuation measures of TELUS, we see obviously that this company is a large cap as well with 40 billion of market cap. And the thing here is that obviously the P ratio is a little bit higher than what we've seen at the past with Enbridge, for example, so about 31. But still, it doesn't only mean the P ratio that the stock is overvalued or undervalued. It should never be the only indicator that you watch when you do invest into a certain stock. Because obviously when we see at the revenues and when we look at them, we see that they are currently growing at a great pace. For example, they have growth of almost 8% in the past quarter, and they are currently around $17 billion. However, compared to Manulife, this company doesn't keep a lot of cash on them, and they have more debt than cash in that case, obviously, and it's pretty much like Enbridge that will impact, obviously, their payout ratio. So as we can see, the dividend yield is quite high, so 4.4%, which is pretty good, and which helped them to classify as a really dividend aristocrat stock in Canada. And we see that also the payout ratio is higher than 100% because, as I told you earlier, they don't have as much cash, for example, and they don't make enough compared to the debt that they do have. And one of the reasons why personally I like to buy TELUS at the moment, of course the P ratio of Bell is lower than TELUS at the moment, but we've seen in the past, as I told you, that TELUS has acquired many clients over the past quarter, and it has impacted obviously their revenue growth, because when we look at Bell revenue growth over here, we see that only about 1% of revenue growth has been acquired by Bell in the last quarter compared to more than 7% for TELUS. So I personally think that TELUS is really one of the top dividend aristocrat companies in Canada. I think it's a great company to have also some diversification in your portfolio, and also it's a company that continue year after years to grow their dividends, which is really something that I admire as someone that also likes to receive some constant dividend and some growth in their dividends. Also, for the customer service, for all my Canadians, you might know that the telecom market is not the best, I'd say, on the customer service, but I think that personally, TELUS is really the number one on that side, while also have a slight advantage on the speed compared to, for example, Bell. They also have the best network coverage footprint in all the Canada. And personally, I think that Bell and TELUS are the two picks that are really interesting to take a look at in this field for the Canadian company. So as you've been able to see in this video, I personally use my TFSA as a Canadian dividend growth portfolio. So there's plenty of ways to use it. I personally use it that way to maximize my fiscal opportunities, I'd say. And I also put some American growth stocks that I think that will potentially outperform my Canadian stocks, like for example Facebook, which I think that will perform pretty well in the future. But obviously, I would like to know what is your favorite and what are your favorite stocks that you would put in your TFSA. So let me know in the comment section what are those stocks. And if you want to see more of this kind of content and you're interested to see, for example, the difference between the TFSA and the RRSP, this is the video that is coming up next week. So make sure to stay tuned, and to stay tuned, obviously, you can subscribe to the North Family. It costs you only $0.00, and I will see you soon. Peace.